Yeah.
It was not until the uranium price had doubled and the price of the uranium juniors had gone up fourfold. Well, I think that's important. I think that people who are new to the silver equities and new to the silver space need to look to the uranium bull market to understand things.
Mm-hmm.
There was a period of time, 2016, 2017, 2018, where the arithmetic behind silver was all over the place. The silver price absolutely, positively had to go up.
Mm-hmm.
And although the facts were in place, and although I explained the facts until I was blue in the face, no one cared when things were cheap.
Yeah.
It was not until the uranium price had doubled and the price of the uranium juniors had gone up fourfold that anybody cared. So the truth is that by needing the validation of price movement, needing momentum for psychological validation, people lost the easy money.
Mm-hmm.
The easy money comes when an asset is hated, when it has to go up, but there's been no validation in the price action. My suggestion to you is that people who have been loyal listeners of yours for a year and a half, in other words, they've been right on the theme, and they have watched the silver price deteriorate for 9 months, and they watched the silver equities deteriorate today, rather than understanding it as a sale, look at it as some evil portent or something like that.
Mm-hmm.
All this is a narrative that you already believed in becoming cheaper, and that's good. The parallel between this and uranium is that when nobody cares or when an asset is out of favor, if you believe in the paradigm around that asset, that's a blessing, not a curse.
Well, you were talking uranium for several years before it launched, as you just said. And I have here the 5-year chart for uranium shared on the screen right now. And, so you were talking about this back when uranium was, in the low 20s, correct? And
yes, sir.
And that was the time to build your position and plan for, this hockey stick that happened this year that now everyone's, thinking it's too late, whatever, it's too late, or but so let's make that comparison to silver in terms of people are kind of upset now. How should we be thinking, Rick?
Well, I think one thing that we should look at, and I really think that this is what your listeners need to do. They need to decide what the probabilities are of a precious metals bull market continuing. In other words, you need to examine your premise when the market action at least challenges your faith in your premise. So the first thing I think that your listeners need to do is consider whether or not the conditions precedent for a bull market in precious metals are in place. We'll help them through that in 2 minutes. Then your listeners need to consider whether history will repeat itself, which is to say, whether the second half of a precious metals bull market will be led by silver. That's assuming that your listeners believe that we're in the throes of a precious metals bull market. And then I think the third question will be, will past be prologue too in terms of the outperformance of silver equities rather than other investment classes available to precious metal speculators? So let's take them one at a time. The conditions precedent to a precious metals bull market. And let's not personalize it and just say Powell, just for fun. I think there are 4 things that investors need to think about, investors and speculators, as to whether or not they believe in the bull market narrative around precious metals. Precious metals have, in my life, been particularly susceptible to fears that investors and savers have had about the ongoing purchasing power of their savings and investment assets denominated in fiat currencies, particularly in the US dollar. For illustrative purposes, I use the US 10-year Treasury, which is the largest and most liquid security of any type in the world. And so let's consider whether a fear of the purchasing power around savings denominated in US 10-year Treasuries is valid. The first fear that I would have is quantitative easing. I have described that on your show before as counterfeiting, because that's what it is. It's the conjuring up of specious units of currency that isn't even related to the need for more currency units in an economy. It's done just to stimulate the economy. It's done just to really deliberately debase the currency.
Mm-hmm.
And people who look at precious metals as opposed to fiat currency need to understand that precious metals has no constituency for devaluation. In the United States, one reason that we might devalue is to make our exports cheaper relative to other countries. Certainly a tool that China has used, certainly a tool that the euro has used. So the voters in many sectors actually want a cheaper currency. They want the currency to go down.
Mm-hmm.
And quantitative easing, that is to say counterfeiting, is a wonderful way to do that. But by its definition, counterfeiting debases the currency. That's just the first. The second, in the US, I'm talking about the US 10-year trap now. My apologies to your European viewers, your Canadian viewers. Debt and deficits. We've talked about this before too. In the US, the on-balance sheet liabilities exceed $29 trillion now. 22 trillion net. That's a T, guys.
Yeah.
Okay, that's 12 zeros to the left of the decimal point. And that's not nearly the half of it. The net present value of the off-balance sheet liabilities, which is to say things like Medicare, Medicaid, Social Security, Environmental Trust Fund, $120 trillion. So at the federal level, before state and local debts, we're over 120 or over 140 trillion upside down. And we propose to service this with a budget that's $3.5 trillion a year in deficit. You know, when you're deep in a hole, you're supposed to stop digging. Right? If that doesn't make you concerned about being a creditor to the US government, that is the party that's obliged to pay back these debts, God knows what will. If I ask God, however, he or she would tell me the crowner is negative real interest rates, despite the fact that the issuer has acknowledged that we will never repay the $140 trillion. Despite that, they are paying you an interest rate that's below the rate of depreciation of the currency. Specifically, the US 10-year Treasury pays 150 basis points, 1.5%, more or less, in a currency that the Congressional Budget Office, not some cranky, bald libertarian named Rick Rule, says is depreciating by 6.5% a year. That means for the first time in my life, the government's telling me the truth. They tell me that if I give them money 10 years from now, they'll give me back much less than I gave them. Franz Pick called this certificates of guaranteed confiscation. Jim Grant calls it return-free risk. It's important for your listeners to understand that if we had a reversion to mean, if we look back at the price of the US 10-year Treasury over the last 40 years, it's offered a positive yield after inflation, which means if we returned to the 40-year mean, the US 10-year Treasury would be offering about 100 basis points premium to the rate of inflation, meaning that the US 10-year Treasury would be yielding 7.5. And by the way, the 30-year mortgage in the United States, fixed rate first mortgage, has traditionally yielded a premium to the US 10-year Treasury, which would take first mortgage rates up into the sort of 8% range.
Gosh.
You think for yourself what the probability of that type of interest rate is. So it is much more likely than not, I think, that negative real interest rates, artificially low interest rates, continue. If there is anything that causes me to be concerned about the preservation of purchasing power in the US 10-year Treasury, it's the fact that the government is guaranteeing me that they won't pay a market rate of return.